Alrighty, folks, it is September, and that means the stock market will have pain. September is the worst performing month. But the good news is we've got Dan Bird here who told us this was coming. A lot of you took action and got prepared, so congratulations. We're going to talk about that and more, but first, let me get something off my chest. Mr. Dan Bird, for a month, probably 2 months now, has been calling for a September rate cut, and I disagreed. I did this morning something that I rarely do. I changed my mind. I now acknowledge that a September rate cut is very, very likely, and that my call for November is wrong. If I had a shirt that said swing and a miss, I would be wearing it. But alas, that's in Vegas. I'm not in Vegas. But yes,
so you
my
dropped your gun. You dropped your guns, basically.
Yeah, I did.
You were sticking to your guns, and then you dropped your guns.
It's stupid at this point. When you got Austin Goolsbee saying rate cuts are coming, you've got John Williams saying rate cuts are coming, you got Bostic not being a dump. I can't even pretend to find a reason that it will skip September. We're getting a rate cut now, a quarter or a half. That's open for debate, but that's the question. Yeah,
so that is.
I was wrong. I was wrong. There we go. Have at it.
That's all right. We're all wrong sometimes.
I'm wrong a lot, but that's okay.
And as I've always said, being in the market, it's not about being right or wrong. It's about making money. Actually, it's about reducing your risk. It's not even about making money. It's about managing your risk.
I like it.
That's the important part.
So we have a lot of stuff to talk about. We got some activity last week, pretty weak tech rolling over. We had a jobs number that was weak. We had 3 bad jobs numbers. We got CPI and PPI next week, inflation. Where do you want to go?
How about the yield curve?
Oh, the yield curve de-inverting for a moment. Yep.
For a moment, it's still de-inverted.
I thought I checked this morning. It didn't. Well, which one? The 2 and 10 or the 3 months?
The 10 and 2. The 10 and 2 is the one that.
Oh, okay.
Everyone.
All right.
I'll show you that.
Okay, cool.
Yeah, we've got a short amount of time today, so we're just doing one video, and I've got a lot of information to get through. So, including a couple of charts that people wanted me to look at, which I'd like to do, because if they took the time to put it in the note in the comments, then I'd like to try to get to it. All right. So for those interested, my website is breakpointtrading.net, and the newsletter is right there in that box at the bottom of the main screen. You can sign up for a reminder for the newsletter with this $0 one. No credit card. We don't share emails. Or you can do a 7-day trial if you just want to try out all the content for 15. If you cancel before the 7 days, you don't pay anything, obviously. And then you get a lot more content, the $99. So that's the website. So let's take a look first at the yield curve. Because I have been saying for a while that recessions don't happen when the yield curve inverts. They happen when the yield curve uninverts.
Correct.
So that's what I've been watching. So if we go here to the 3-year, and there's the uninversion right there. Can you see it right there?
I do, yeah. Just ticked up, yep.
Turn on my thing right there. So it's now uninverted. More than 2 years, by the way. Yeah. It's been inverted. So also on the market bias page, you can get a closer in view of the yield curve, 10 and 2. So I put this in the newsletter this week. Let's count the number of times it uninverted. There's 1, 2, 3, 4, 5, 6. And Friday was 7. So 6 times it went above 0, but did not close above 0.
I was going to say there's only one day it closed above, right?
Only Friday. Friday's the only day it closed above 0.
Okay.
But it tried to get above it 6 other times. So I think the yield curve is now uninverted.
Okay.
That is one of my recession watch components. So that's been satisfied. Right here on the charts page, recession watch, the inverted yield curve. Now we can check that one off. the unemployment rate. We look at claims right here. This is the last month or so.
Yeah, it's been
Claims,
remarkably stable.
not only stable, but declining.
Yeah, I saw that. Yep.
And that's why I said last week when I did my solo one, I said that the unemployment rate will probably come down as well.
Yeah, I
Forecast
called
was
that as well.
4.2. I said 4.2 is probably right. Potentially could go a little lower, but I definitely think it will go down because claims went down.
Yep.
And that's what happened.
Nailed it.
All right. So the unemployment rate spiking like it has is also number 2 on my recession watch.
Yep.
And then number 3, of course, is the
Rate cuts.
Rate cuts, which are coming week after next.
Yep, Wednesday.
So we'll
Yep.
have three check marks. So recession in 6 months. So the big question is the market anticipating that now and starting to decline?
Mm-hmm.
Or is it declining because September is usually always weak? In the last video, I said there were some potential catalysts. One of those was the uninverting yield curve. People might view that as the economy getting back to normal. Maybe that's a good thing.
Right.
The other catalyst was the unemployment rate declining, not continuing to go up. Would the market look at that and see that as a positive? That happened Friday and the market sold off Friday.
Yep.
All right, the next catalyst coming up is CPI. So
yeah, CPI expectations, at least for headline, was a shocker to me.
Yeah, headline was 2.6.
Yeah,
I
and last
said
month
it
was
would be
2.9.
2.7.
Yeah.
I said we probably get 2.7. Headline said 2.6. By the way, I listened to a video by Tom Bowley this morning.
Okay.
And he was implying, I don't know why people are saying the CPI is going up, that inflation is going up. I don't see that inflation is coming back. Everyone's saying inflation is coming back. And I'm thinking, well, who's saying that?
Yeah.
No one's saying that right now.
I mean, the only
saying
thing
inflation's under control. So here's the August one. So this is the 12-month base effect.
Yep.
So when one gets added, then one drops off. The one that dropped off in August was a fairly big one. So the rate went from 3 to 2.9, under 3% for the first time in quite a while.
So this next one is the biggest one on record? Or
this is
the
biggest
one of the series?
Yeah, the biggest one in the last, 18 months or so.
Wow. So so 2.6 is very likely because also commodities have rolled over.
2.6 is very possible. 2.7, I think for sure we're going to get 2.7. But we're going from 3 to 2.9 to 2.6. Let's say that's a huge drop.
Oh yeah.
Look at the one that's coming the month after that. It's almost as big.
Yeah, we're going sub 2.5.
Yeah, we're going to be 2.5 or below by October, which I've been saying for 3 months now.
You have.
So that's
so let's play this out because that's important. So let's just say CPI headlines below 2.5 or below in 6 weeks. You have unemployment, let's just call it 4.3. So not meaningfully worse than it is currently. Again, in 6 weeks.
Right.
GDP last printed at 3. I think the last print was 3%. I mean, certainly doesn't scream recession.
Nope. It doesn't. In fact, what it screams is soft landing.
Yeah. And I think
maybe we even get back to normal without a recession.
Yeah, repeat of 94. That was the last.
That's right, 94, 95.
Correct.
Which is a secular bull market, by the way.
Yeah, and Austin Goolsbee was the one. Austin Goolsbee was actually the comment that made me finally give up on November. He said, if we are going to have a soft landing, we can't be behind the curve on rates. That was the quote that I like. Okay, I give up.
Right.
They're trying to thread the needle on a soft landing. So a September cut's coming.
Yes, absolutely. And the question is it a quarter or a half? If it's a quarter, it's going to be, that's the other catalyst. If it's a quarter, it'll be positive, should be positive for the market. If it's a half, it will be negative for the market.
That's funny because that's exactly what I think too. I think a half, it's kind of like if a half comes, the market's like, be careful what you wish for, because the Fed is saying we have problems. We're behind. If they do a
Yeah.
quarter, they're like, we got this. We're trying to turn off the boosters so we fall gradually.
Right. Yes, that's right. And yeah, here's 94, 95 right through this period right here. 95 is right here. So that was the first rate cut in 95, no recession.
Yep.
Then we had another rate cut right here. Took 15 months to get to the recession. So, I mean, I would say no recession there either. And then the final one was here in 2000.
Yeah. It's going to be
Right at the
interesting.
end of right at the end of 2000. And then 6 months later, we had a recession.
So let's talk about the recession, because I think most people, certainly our age and below, just know of nasty, all-inclusive recessions.
Yeah.
.com, Great Recession.
Yeah, the last
COVID.
three you're looking at right here were all at once recessions.
Yeah, all at once recessions. I have said probably for a year now that this just feels like a rolling recession. And obviously I think real estate got hit first.
Right.
You know, a rolling recession won't probably show up on this screen, right? We could bounce
it probably won't. That's right.
Right. And that's what 98 was. 94 is the soft landing. 98 is often quoted as the rolling recession. In economic speak.
That's right here. That's 98.
Yeah.
Yes, so, that's correct. I mean, we did get an all at once recession in 2001, of course.
Yep. .com. Yep.
Right. So if we get a rolling recession in 05 and
2025,
25, I'm sorry, 25.
Okay. Yep.
The market goes down like it did right there.
Yeah.
Which I'm kind of expecting it to look like 22.
Okay.
Like this.
And what is that percentage wise? Is that like
it's 15? I think it's about 15%. Yeah.
Ish. Okay. All right.
Right. It's a cyclical bear market.
Gotcha.
Inside of a secular bull.
Got it.
That's kind of what I think might happen in 25.
So just to be clear, that's 25. That's not, hey, it already started in September.
That is correct.
Okay. All right. I'm with you.
I do not think the recession has started yet.
Well, I was actually referring to the stock chart because those can happen at different times.
Yeah. Right.
Okay. So you're saying the 15% drop in the stock market, it hasn't already started. That is sometime in 25.
No, it has not. I think we're going to get a rally at the end of this year still.
Oh, okay. All right.
I think September is always the worst month.
Got it.
And October, the first part of October is always bad. In fact, let's just go right to my S&P chart. So there's the chart. I said on this channel a while ago that I think this will look similar to what 2023 looked like. We had down, up, down, up, down, and hit a low the end of October. All right, so there's the down, there's the up. By the way, we did not get back to the high. So it looks like a double top, and it is, technically it's a double top. But this one did not get back to this high. So it's also a lower high.
Got it.
Okay. And then we broke through the 20-day, 21-day right there. Broke through the 50-day on Friday, went right down to the 61.8 Fibonacci level on Friday. We probably will continue lower. Could get down here to 5,200, 5,250, which is the 38%. And then we could even go back to the August lows.
Wow.
Which is around 5,100.
So you see a relatively ugly next 4 weeks.
Yes.
Okay.
Yes, choppy at best, but yes, I think we will continue lower. Okay. But then in October, and especially after the election, we're going to go up and into the end of the year.
A relief rally post-election.
Relief rally, and sometime we might even take out the highs by the end of the year.
Okay.
And then by middle of January, the recession idea is going to kick in, and the market will then sell off, and we'll get a bear market in 25.
All right. So bear market 25. Secular bear market.
Secular bear market. All right. So the other thing I want to look at is commodities as we go into the CPI number. Oil
is rolled over. Jeez.
Oil and gas. Look at gas.
Oh my goodness, I did not
Oil and
notice.
gas right down here.
And
So
CRB is
these
food, right?
CRB is all of these things right here:
Oh no, over there.
agriculture,
Ugh,
energy, industrial metals, precious metals.
wow.
So the lines are moving average lines. So those are all 5-day moving averages. The dots that you see here are the actual numbers.
Got it.
So gasoline and oil, gasoline's way down here.
Hmm.
I mean, the CPI will be for this shaded area.
Right.
So even though gas and oil fell significantly off a cliff, some of the other areas kind of went up. Copper went up
Right.
a little.
Right.
So agriculture, the purple one, DBA, went up a little.
Hmm.
All right. But in general, all the commodities are going down, especially gas and oil. They're definitely going down. If I actually bring this out to 3 years, you can see where peak oil was right back here. So there's peak gas and oil back there, and we're way down here. We are below everything all the way back to 21, basically.
Hmm.
Almost all time, not all time lows, but for the
Yeah.
last 3 years, it's at a low.
Yeah, it's really interesting because the thing that I've been looking at with commodities is not only is it a sign of perhaps a US recession, I'm now thinking it's a sign of a worldwide recession because I think there's a lot of agriculture that was, I don't know, influenced by China. And dude, I think
Mm-hmm.
China's in trouble.
Mm-hmm. Yeah.
So, yeah.
Yeah, I don't disagree with that. I think it will be a worldwide recession. I think the big one isn't quite here yet, though.
Okay.
The big one is still coming, 29. So got about 4 more years.
Got it.
All right. So commodities, let's look at the sectors for a second. If I go to here, here's the sectors over here.
Mhm.
This is for Friday. You can see real estate, staples, healthcare, utilities. These top 4, those are all defensive,
Mm.
right? The aggressive sectors are technology, discretionary, and communication services. They're all at the bottom.
Yeah.
So the sectors are telling us that there's rotation going on. If I look at the 10-minute charts right here, here are the aggressive sectors. All right. So here's this line right here is from Monday's open. So that's the whole week. So that's what the S&P did for the week. Here's technology, makes up 31% of the S&P. Financials actually did pretty well. I think financials will continue to do well, and bonds will do well. Discretionary actually had a fairly good week, actually ended higher than it started. Communication services was flat, and industrials was pretty much flat. If I then look at the defensive sectors, much different story. Healthcare, definitely higher. Staples, one of the most defensive sectors, definitely higher. Look at utilities, definitely higher. So the rotation is out of aggressive and into defensive. As long as that rotation happens, the market will come down, but it won't crash.
Right.
It crashes when the money comes out of the market completely, out of
Yeah,
all the
very big difference between rotation and exiting.
Right. That's right. So the other thing is the bottom finder chart, which I put in. I showed something before, and somebody asked me if I could just put it on my website. So this is my bottom finder chart for the NASDAQ. So this is where I'm looking for a bottom. And these vertical lines right here are the bottom. So there's a bottom. This one is the NASDAQ 100. There's a bottom there. There's a bottom there. There's a bottom there. So that's the vertical lines. And you can see where it lines up with all these other things. So the MACD went below 0. So confirming a downtrend back here, it did it again last week.
Okay.
Down here is percentage of stocks above 50. Now, the important thing to notice here, so here's the one from 23. Here's the one from April. Here's the one from August. We are not even down to August yet.
Interesting. Okay.
Percent of stocks below the 200-day. There's 23. This one really didn't come down much at all. And here's the one for August. We're not even down there yet.
Right. Okay.
And then the VIX, of course, the VIX usually spiked
Yep.
above 20
VIX woke
here.
up.
Didn't quite make it to 20 there, but it's back above 20 again right here.
Mhm.
But it's got a long way to go too.
Yep.
Bullish percentage index, not even back down to the critical line down here. And then the advanced decline line is also right in the middle. So this tells me we've still got more to go.
Okay.
More downside left to go. We could get back down here to the August low. We're almost at the 200-day moving average right now. I think we probably will have a little bit more downside and we'll have a little bit of a bounce when we get there. But we could continue down again until middle of October. And then that's when the rally starts into the end of the year. Okay.
Gonna be fun.
We got about 10 minutes. Any
Yeah,
questions or anything else you want me
no,
to
let's
look
make
at
sure we
before I get
take
to some of the stocks people asked about?
Yeah, let's take care of our audience. We both care about them. They took the time to leave the comments. I think you had 3 companies or 2 companies in a commodity.
Yeah, and let's do the commodity first because
Okay.
the question was about gold and about a chart saying that gold was going up and this guy was getting ready to sell his gold. And I said, might not be time yet to do that. And I want to make a point when we look at these also. So first of all, this is gold compared to the S&P going back 34 years. Okay.
Mm-hmm.
So it's a relative chart, which means if it's trending down, that means the S&P is outperforming. If it's trending up, that means gold is outperforming. And you can see where S&P is outperforming right now. And you can compare that to what happens with the US dollar. It's almost a mirror image. Right. You can also look at the secular bull and bear markets that I've talked about. So during a secular bear market, gold outperforms the S&P. Right. During a secular bull, like we're in now, the S&P outperforms gold. Now, gold is just beginning. It just put in a higher low right there. So gold may be just beginning to outperform the S&P again.
You know what? When I look at this, when I look at these 2 charts again, don't know if you're going here, but I got to share it anyway. This is really more about gold being a US dollar debasement. That's what's happening. If you compare it to the stock market, it's not performing very well. But if you look at it in dollar terms, it's doing okay.
Yes. Okay. Yes, actually, that's true. And I didn't have a gold versus the US dollar. I just had the actual US dollar right here.
Right.
I didn't think about doing that, but I certainly could. But just keep this in mind when we look at gold, because the point that this subscriber made was, hey, I bought some gold at $14.50 an ounce about 10 years ago. Right. And it's almost doubled now. So I'm glad I kept it.
I think his point was it did nothing for 9 years. I was going to sell it. You told me not to. It doubled. Thank you. Should I sell it now? Let's be clear. That's what I think the real question is.
Yeah, that was the question. And I can't tell people what to do because I'm not an investment advisor.
Not financial advice. No.
But let's take a look at it on a chart right here. So it's a little smaller. So the one on the top is just simply gold and the S&P. So the S&P is in green, gold is in gold. All right. And he said 10 years ago, but when I went back and found $14.50, the price that he bought it at was actually in 2013. Okay. So that's about 11 years ago.
Got it.
All right. So that's right there. And that's where the S&P was at that time. Yep. And you can see, yes, gold went nowhere. It actually went down and then came back and broke even right here in 2019. Okay. And then has gone up from there. Now, since that time, gold has gone up 175%.
Yeah. Yep.
But the S&P has gone up 450%.
That's a little better.
That's a little better. The next one down here actually puts them both starting at the same point. Puts them both starting back here. I started them at the beginning of the bull market, the bull run in 2009. All right. So both of them starting at 0 in 2009. If you had bought both of them at that point, you can see gold first outperformed, and then the S&P caught up in 2014, and the S&P never looked back.
Yep.
The S&P is definitely outperforming gold. And then the one down below is the gold versus the S&P. So again, if it's going down, that means the S&P is outperforming. If it's going up, like this period here, that means gold is outperforming. So yes, almost doubled your money from 11 years ago, which seems like a pretty good run.
Yeah.
But if you would put your money into an S&P, if you put it into SPY, an S&P ETF, you would have far outperformed gold.
Got it.
So the lesson here is, if you, either way, 175% is not a bad return.
No, not at all.
Right? Although it's over 11 years. So that's about 16% a year.
Okay.
And 450 over 11 years is
40%-ish.
40% a year.
Yep. Okay.
But my point is, if you want to stay invested for the long term, if you're not a trader, you're an investor, then do it for the long term. And either one of these has done really well, although you had a very painful period for roughly 6 years to go through with gold. But you could also put it into the S&P and just leave it there.
Yeah.
And then forget about it. You don't have to watch it all the time.
Yeah. Well, very cool. We're running out of time, so let's make sure we hit those other two companies.
Yep. So Redfin and Rocket. First, I wanted to show them this way. This is actually probably the best way to show it. Redfin's on the left, Rocket's on the right. The first one is an intraday view. So this is basically, what it did in the last couple of weeks. Intraday.
They're essentially the same chart.
They're almost the same. They're both in real estate. One actually, Rocket is in mortgage finance.
Right.
And Redfin is in real estate development.
Okay.
But both of them roughly in real estate area. If we look at it on a daily view, they still look kind of similar, although Rocket looks like it has a much smoother uptrend, whereas Redfin is a little choppier down here.
Well, that would make sense to me, knowing both companies, at least at my level. Rocket is in the mortgage business, which I think is going to benefit from lower rates and refinancing earlier. Right. Redfin's in the, I'll call it marketing and sales area, which is, it's not going to pick up minimum till Q1 because all the buyers are pulled back and sellers aren't cutting prices. So it probably makes sense to me that Rocket's business turns first.
Yeah, I agree. I agree with that. Now, both of them are basically, from a chart perspective, are essentially in the same place. They're both sitting right above their 21-day moving app. Oops, I didn't mean to do that. Guess I can't click on the chart. Both sitting right at their 21-day moving average. Both of the momentum indicators are starting to roll over or cross, but they haven't gone below 0. In fact, they're a long way from 0 still. So they're still confirming an uptrend. So they both actually look pretty good right now. If we go down and look at a weekly view, a longer term, this tells a much different story. Here's Redfin, which has basically just done nothing.
Just flatline.
Right. Flatlining down here below its 200-day moving average.
By a mile.
Actually, it's a 200-week moving average, I should say. This is a weekly chart. It's right on the other moving average, sitting right on them. So yes, it could go up, but it may not really, it'll probably struggle to try to get back there. But if we look at Rocket, on the other hand, it's above all of its moving averages. It's got clear skies above, and its resistance is, up here around 25, and it's not that far away from it.
Yeah, that makes sense to me.
Close at 1931, almost $20. It's not far away from, key resistance. And down here is how it's doing versus its industry group. Rocket is definitely outperforming, whereas Redfin is basically just going along for the ride with the rest of its industry group, which kind of makes sense from what you said too. Yeah,
Rocket's going to benefit from the refis and wait for purchase to explode. Redfin gets nothing, almost nothing from refinancing picking up. They're all about purchases. They're in trouble for another 6 months at least.
Yeah. So
Okay.
from my perspective, Rocket looks like the better play here.
On the charts for sure. Yep.
Yeah.
Very cool. Well, do me a favor, show your website one more time
Sure.
as we wrap up this quick episode.
You bet. Breakpointtrading.net. Just go there. And if you have any questions or want me to look at something the next time, put it in the comments down below. Be happy to do that either on the midweek or next Sunday or whatever. And just be prepared for a very choppy market the next few weeks.
You heard him. You heard it here first. Choppy market. Thank you, brother.
All right. Have a good one.